Joining me now at Post 9 to break it all down is SoFi's head of investment strategy, Liz Young. Welcome back. Is that the dominant story? Yields, we're watching them move higher again?
Yeah, as it should be, right? I mean, we've got fresh highs in the 10-year. You've probably got mortgage rates that are going to creep closer to 8%, fresh highs in the 2-year. And then all the chatter is about, oh, the Fed will be done. They're going to stop hiking rates, and that's bullish for equities. Well, they may not have to hike rates anymore because the bond market is doing this for them. But that is not bullish for equities, particularly on the short end of the curve. So if we were making fresh highs in the 10-year and the 2-year was slowly grinding lower, maybe a different story, but that's not the case.
I mean, most of the Fed speak of late has been sort of leaning towards we don't have to do anymore, potentially because the bond market's done all the work for us. So there was, perceived to be a dovish pivot, if you will.
Sure.
Maybe Waller was a little bit on those lines today, too, and he's been somewhat hawkish. Now, the Fed chair himself talks tomorrow at the New York Economic Club, and those are his last comments before the quiet period before the meeting. Mm-hmm. How do you factor all that in? What if the Fed is done despite the fact that rates are where they are?
Well, I'll be at that presentation tomorrow, so I'm very interested to hear what he has to say. I factor it all in the sense that I don't know that it matters whether they're done or not. It's the damage has already been done. We've raised rates so quickly, and now I think we're finally seeing some of it coming out in some of the credit spreads. You're seeing high yield spreads start to widen considerably, especially if you look at that at a time when the 10-year has risen, right? 10-year yields have gone up. You're still seeing spreads widen on that. I think it's starting to come out in the wash. I don't think that 25 basis points makes that big of a difference if they go again. And I do think that the last couple hikes have really been just more about the narrative than the actual move itself. They can be done here, but the cracks are already starting to form.
It's funny, we talk about cracks, and you've had, I think, a more cautious outlook on the economy than some others. The Beige Book was out, 2 o'clock this afternoon, anecdotally agrees with you. The data doesn't necessarily agree with you. I mean, the data has been strong.
Yeah.
The anecdotes are concerning. The Fed says it's data dependent, going more with the data than the anecdotes. How do you factor that in?
Well, I mean, data is effectively backward looking, so it hasn't shown all of the stress yet. Some of the high frequency data that we get is weakening slightly, but a lot of the stuff that we're waiting to react is things like the labor market, consumer spending. Consumer spending and the labor market are very closely tied to one another. Consumers will spend as long as they're employed. So a lot of that stuff is too far backward looking to really rely on in the moment. The anecdotes are important, and I think there's a lot of pressure on CEOs right now in this earnings season in particular, and probably in fourth quarter earnings season, because expectations are so high. And nobody wants to be the first company that comes out and says, you know what, we're not going to make it.
You think expectations are high? I mean, I would almost argue that they're kind of low. It's not going to take much to get over what feels like a reasonably low bar. The expectations sort of ratchet up as you move forward into the next quarter and then into next year. But right now, they feel kind of low.
Well, for the third quarter, they're kind of low. They're unimpressive, right? We're hoping for maybe a 1% positive growth number, and that was up from a negative 0.8 number. Mm-hmm. So this could mark the end of the earnings recession, but I'm talking more about fourth quarter results and into 2024.
Okay.
The commentary that we hear from CEOs right now is about that forward-looking period. And if they come out and start to have anecdotes that say, you know what, we might not get there. We're going to try to prepare the market for that right now rather than surprise them later with negative results. If we start to hear more and more of that, it's going to be hard for markets to get to a place where these valuations make sense. We're really priced for a pretty good period right now. We're priced for good earnings going forward, and the equity risk premium is very low, if not zero. So you're not getting paid to take that risk.